Good morning, good afternoon, and good evening, everyone, and welcome to our Winter 2026 M&A Bootcamp. My name is Colin Mahan, and I'm a director of high growth impact entrepreneurs and head of sponsorships at the Nasdaq Entrepreneurial Center. And good news for all of our presenters today is finance and scale look like they are at the top of the key. And we're going to be discussing a bunch of that in our M&A Bootcamp today. So without any further delay, please join me in giving a warm welcome to our first special guest who's going to be talking about the M&A market. JayJung is a principal and founder at Embarc Advisors. Jay, welcome.
Hey Colin, great to be here.
So excited to have you. Well, before we dive right in, maybe I just allow you to introduce yourself and talk a little bit about the work you do, and then we'll jump in.
Yeah, sure thing. Appreciate the opportunity. So, Embarc Advisor is a firm that I started about 7 years ago. My life prior to that, I was an investment banker at Goldman. So I worked on a lot of large and small deals across different sectors from natural resources, industrials, and tech. Notably, I sold Yahoo to Verizon. I did the MuleSoft transaction to Salesforce.com, and I sold SanDisk as well. Before Goldman, I was in McKinsey in their corporate finance practice. So I've been doing M&A for over 20 years now. But before all those glory days in the early 2000s, I did do a tech startup in the network security space and raised money from SoftBank and some VCs. That endeavor did not go so well. So here I am. And the idea behind Embark was to kind of take the skill sets learned from the big firms like Goldman and McKinsey and bring them to startup founders and middle market business owners to help them, grow better, manage their finances better, and ultimately exit better. And so we're a 25-person firm now at this point, throughout the country, and primarily working with middle market firms, revenues anywhere from 5 million to say $100 million, give or take. So that's who we are. Great to be here.
Great. All right, Jay. Well, speaking of numbers, the numbers say in the market that M&A is back, roughly 4 trillion estimated for 2025, up from 2.8 trillion at the 2023 trough, if you will. But is this a genuine structural recovery, or or are we reading a bounce that could fade?
No, I think all signs kind of point towards a structural recovery here. You saw interest rates stabilize and then come down. That's certainly a tailwind. This administration has a much more friendlier stance towards M&A, which is also helpful. I mean, 2021 is not the right benchmark because 2021 was a real anomaly that was pushed by zero interest rates and stimulus liquidity. But I think we are kind of going back to the trend line with 24 looking better, and then 25 certainly picking up steam. And the momentum seems to continue into 2026.
Awesome. Well, so you mentioned a little bit about the Fed. Two big things changed in 24 and 25. Fed cut rates. New administration came in with a very different posture on antitrust. So, which of those two changes has actually moved the needle for real deal activity?
Yeah, I think the FTC and the antitrust gets more of the news headline, but I think fundamentally the interest rates have a more foundational impact on deal activity, mainly because what you see is when the Fed started to raise rates, certainly from a zero interest rate environment, that really stalled deal activity, mainly because the cost of deal making went up, and a lot of these deals are financed with debt, in particular floating rate debt. So as rates keep going up, it's very hard to underwrite transactions. You don't know how high the cost of interest might end up. So that's why you saw deals really stall in 2022 and 2023. And as I mentioned, towards the end of 23, when the Fed announced that they're done with rate hikes, that really stabilized everything. And now, as rates are coming down, that's really icing on the cake, and it makes it much more easier for buyers to underwrite deals, and also recognize there is a little bit of upside as rates come down. So I think that's really been the big push for the last, say, 18 months. Now, with all that said, I do think the general posture change from the FTC, is a positive. If you think about a scaled tech company, there's really only two ways to exit. Either you go IPO, or you get acquired by one of the, big serial acquirers like Microsoft, Google, Facebook, Meta, etc. And in the last 2 years, the IPO market was shut, and there was a lack of confidence in these big tech companies and their ability to consummate deals because the FTC was publicly challenging them in a very aggressive stance. So I think the two factors are both headed in the positive direction. But I will say, to answer your question, interest rates are probably the more foundational piece.
Mm. And in January 2025, DeepSeek dropped the open source model that matched proprietary AI performance at a fraction of the cost. It caused a significant valuation reset for some AI companies. So, how should founders in this room think about whether their AI is actually defensible moat or just a feature?
Yeah, that's a really good question. I think, the AI technology landscape is evolving so quickly. I'm hesitant to even comment here because I think in a week's time it'll be stale. But the DeepSeek drop was certainly a pivotal moment, and I think the recent paper from Sequoia by Julian Beck, where I think the title was "The Next Trillion-Dollar Company is going to be a software company masquerading as a services company" or something like that. I think that one really hit the nail on the head because ultimately your moat is going to be whether you drive outcomes. It's no longer in the code or the product you're developing. It is going to be almost like a services company in the sense that the end user will purchase the product if it delivers real outcomes. And I think that's going to be the moat for companies going forward. If the company is a great use case for AI that was vibe coded very quickly, that's exciting, but does that really drive sustainable revenue growth? That's questionable. So until a company gets there, I would say, it's still to be determined.
Yeah, and the amount, as you mentioned, the amount of AI news that hits every week is just yeah, it's like up and to the right graph. It's crazy. So yeah, we'll see.
Yeah.
For the founders and startup execs in this room who are thinking about exits in the next 1 to 3 years, what are acquirers actually scrutinizing last year, this year, that they weren't 2 years ago?
Yeah, and I think that's it kind of parlays into the earlier point about building a moat, whether it's an AI company or not. The deal making environment was very different in 2021, 2022 with interest rates so low, and it was a very fast moving environment. I would say that has changed now. Buyers are much more diligent. And in particular, they're focused on, let's say, the quality of the revenue. Buyers want to see that the company has not only brought a interesting product to market, but that they have demonstrated durable and sustainable growth. That means they're digging into how they are acquiring customers, whether they are able to retain those customers, and how they're growing those customers. I think when you kind of dig into this, the second layer for some of these fast-growing companies, you do see that their annualized revenue might be growing, but then on the backside, you see that they have also a lot of churn. And that kind of implies that it's maybe like to your earlier question, it's an interesting feature, but there's no durability in that revenue. So buyers are certainly digging into that. And then, so I think the go-to-market becomes a really key piece. And ultimately, they want to see a path to cash flow break even. Buyers aren't looking to buy a company and then fund that into perpetuity.
Mm. Yeah, revenue is king and queen these days. If you're running corporate development at a mid-sized company right now, say 500 million to 300 to 5 billion in revenue, what's the one thing you should be doing differently in this environment versus 2 years ago? So the boot camp covers both the sell and the buy side. So any advice there?
Yeah. 2022, 2023, in some ways was a really good market for corp dev teams because valuations came down, and it was somewhat of a buyer's market if you could bridge the valuation gap. And I think it was a good opportunity. But as we're rolling into 2026, and as I mentioned, there's a lot of good things going for the M&A market. Volumes are picking up, with the tailwinds of interest rates as well as a better regulatory environment. So I think that kind of buyer's market sentiment is going to fade. That means corp dev teams have to be much more proactive. And so we're seeing companies that are well funded, that have the cash to do these acquisitions, take a more strategic and deliberate stance towards corporate development. What does that mean? It's essentially a long-term enterprise sales cycle, so to speak. They map out the market on where they want to go, and they're building those relationships. They're building the relationships with founders, business owners, etc. Even if the transaction is not imminent, they want to make sure they're top of mind when they do come to market, whether it's 12, 18, 36 months down the road. So in that sense, it very much is like a long-term sales cycle, building that relationship and ultimately kind of being in pole position. And what you see, especially in the middle market, is frankly, a lot of companies um, won't run a process. They feel like once they hit their target number, they're ready to transact. So in those cases, that kind of relationship and emotional rapport becomes even more valuable. And we see that companies that have already been investing in this kind of M&A go-to-market motion and building those relationships, they're coming out on top. They're able to continue to execute on acquisitions at increasing velocity. So I think that's going to be the key path going forward for a lot of these corporate development teams as they mature into the new environment.
Love it. So we're painting a pretty constructive picture here, Jay. Rates down, antitrust lighter, AI driving demand, PE re-engaging. What's one tail risk you'd flag that would flip this environment? The thing that isn't getting enough attention, if you will.
Well, um, I think with this morning's news, my thoughts might already start to become stale here. But as I mentioned, the foundational shift here was that interest rates have been coming down. But if you read into the Fed's commentary, they did say that if they see inflation going up, and in particular, they noted energy prices, um, they kind of reserve the right to change course. And now with all the geopolitical risk happening in the Middle East and crude prices shooting at up to over, I think it was $113 per barrel this morning, I do think that could kind of percolate through the economy and start hitting energy prices. And then we'll see how the Fed feels about that because I mean they look at the whole basket of inflation, but energy prices is certainly one aspect of it. So I think down the road, if this kind of environment, this interest rate environment shifts and creates more uncertainty, in addition to this, the uncertainty around politics, but also uncertainty on the economy, I think that also kind of could stifle deal activity down the road.
Yeah. Um, all right, we're almost time, and if you've got a question for Jay, we can field them. But before we do that, for a founder in this room, Jay, who's 18 months from wanting to run a process, what's the single best use of their time between now and then?
Yeah, I recently gave a presentation where, I thought about what is the, highest ROI move you can do in terms of preparing for a transaction. And I told people they should do a quality of earnings. A quality of earnings essentially looks back at the company's 3 years worth of financials and then, normalizes everything, adds back non-recurring, non-core operation expenses, et cetera, to kind of paint a true picture around what the adjusted EBITDA is. And, unless you're a fast-growing, maybe like cash flow negative tech startup, a lot of companies do ultimately trade on EBITDA. And what we find is, unless you do a quality of earnings, you don't really know what your fully loaded adjusted EBITDA is. And even if you find $10,000 worth of additional adjustments at a modest 8 times multiple, you're already 2xing or 2.5xing your return on the Q of E. In most cases, frankly, we see hundreds of thousands, sometimes millions in adjustments that were missed because, some of these companies have been operating for 10, 20 years and things pile up that people don't notice. And that's just low-hanging fruit for the buyer. So if someone is looking at, say, like an 18-month horizon, I think doing a quality of earnings as an initial assessment to see where they stand. And it also gives them a picture on where they can improve with the highest ROI as they invest in the next 12 to 18 months to get ready to go to market.
Ah, that's great advice. Okay, so there's a question here. The cost of planning is greater and the cost of experimenting than the cost of experimenting. Do you agree that this is a great impetus to give teams good criteria, but let a thousand flowers bloom?
It, that's a very metaphoric question. Is
I
that
know.
related to
As I was
M&A
reading it, I
planning?
go, yeah, I think
M&A
so.
planning, or is this AI experimentation? Maybe there can be maybe clarification there.
Yeah.
I do think in general, though, Frank, being an entrepreneur myself, and I'm working with a lot of companies that are moving quickly. Um, I think failing fast is still a good mantra. You kind of have to experiment to see what works, what doesn't work, whether you're doing acquisitions, you're investing in technology. But I think it's important to kind of not fall into some cost fallacy, set up a budget, set up targets, and then fail fast. I mean, we always fail, and then we always find the ones that work, and we accentuate the impact of those. So that's kind of my general take on that, whether you're doing M&A um, or other strategic moves.
Awesome. And yeah, they just added flavors. Real question is about just that, failing fast. So you nailed it.
Great minds think alike, right?
Yep, perfect. Well, Jay, let's see. There's another question that came in here. Um, if acquirers are increasingly look or are looking increasingly for signs of durable and sustainable growth, what are some things or signals metrics they are looking to see?
Oh, that's you're referencing this question from John, right?
Oh no, it's in the Q&A box.
Oh, there's a Q&A box.
No, it's all good.
Sorry. Can you repeat the question then? I don't see that
If
one.
acquirers are looking increasingly for signs of durable and sustainable growth, like an example is increasing revenue, yet also not churn issues, what are some other things, signals, metrics that they are looking to see?
Yeah, so I think that's really where kind of like a CFO and financial planning and analysis comes into play. A lot of times when we're on the buy side, we send our information request list. For example, one of the first questions is show us your historical financials, and then people will just go in, pull the numbers from QuickBooks or NetSuite, and then send over the raw financials. Frankly, we would never do that if we were on the sell side, because what you want to demonstrate is you want to demonstrate your metrics that build up to that financials. Look at like the quarterly earnings deck from a public company or an analyst day from a public company, and w you want to show anything that all the drivers that you are tracking that can support the growth story. For example, we have a client that has a phenomenal sales team, and you want to demonstrate how you've been hiring those sales teams, how you've been ramping them up, how they continue to hit their quotas or exceed their quotas, because that's their growth engine. And unless they track those metrics and illustrate that to them, the buyer won't know. The buyer will just see they're somehow growing their revenue. They are adding a lot of customers, but they don't really see the underlying data behind it. So whatever you're doing, whether you're selling into retail, whether you're selling to enterprise or a sales force, going another layer deeper to kind of provide that visibility, that makes a big difference because it gives the buyer confidence to underwrite the growth going forward. And when you can underwrite the growth, that's how you get a higher multiple.
So, well, we are at time, Jay. So if you didn't get your question answered, feel free to reach out to Jay on LinkedIn. I'm sure he's more than happy to connect with folks. But yeah, Jay, really appreciate you joining us, sharing some of your insights on the M&A market, and for joining us today.
Yeah, it's great to be here. Thank you, Colin.